Hare Krishna. Welcome to Tax Guru YouTube channel. This is C.A. Rohanar Pingle, practicing chartered accountant based in Mumbai, also partner in Motilal and Associates LLP, member firm of Marks Network. Welcome to video series What Law Says. And today we are going to discuss income tax cases reported to ITAT and High Court, Part 9. So let's dive into it. Let me allow to share my screen. What law says? Direct tax part 9. Let's start. First case. Urmila Rajendra Mundra versus ITO, ITA number 577 Jaipur 2025. Relevant assessment year is 2022-23 and date of order 1st August 2025. Relevant section is section 270A. Let's understand facts and issue of the case. The assessee claimed capitalized interest expense in computing capital gains, that is, interest was added to cost of acquisition. The AO disallowed the said capitalized interest in the computation, which reduced the cost base and increased the taxable capital gains. AO initiated penalty proceedings under Section 270A for misreporting on the basis that the interest capitalization claim was not correct. So issue was whether disallowance of the capitalized interest in computing capital gains can amount to misreporting under Section 270A, thereby justifying penalty. Very interesting. Let's understand what tribunal observed and held. The tribunal held that claim of capitalized interest was a bona fide claim. What tribunal held that the claim of capitalized interest was what bona fide claim, that is a genuine claim, even though it was disallowed. Mere disallowance of a claim. Please careful. A mere disallowance of a claimed item, here capitalized interest, doesn't ipso facto make it a misreporting. What is important is mere disallowance of a claim of any item, like here capitalized interest, doesn't ipso facto make it misreporting. The tribunal relied on precedents, including the Supreme Court's decision in Reliance Petro Products Private Limited, which draws distinction between mere disallowance versus misreporting. So, in other words, unless there is a specific evidence of fraudulent intention, suppression, or distortion in the return, penalty cannot imposed simply because an item is later disallowed. Very important. Please note down. Unless there is a specific evidence of fraudulent intention, suppression, or distortion in the return, penalty cannot be imposed simply because an item is later disallowed. The tribunal deleted the penalty under Section 270A. It held that disallowance of capitalized interest doesn't automatically amount to misreporting. A bona fide claim, even if rejected, cannot attract penalty under Section 270A. Next, Bhagwan, Vardhman, Shwetamber, Murtipujak, Tapagacch Jain Sangh versus CIT ITA number 2378 Mumbai 2025, assessment year 2012-13, date of order 23rd July 2025, and relevant sections are section 144 and 263. Let's understand facts and issue of the case. The assessee, a Jain Sangh, file return for assessment year 2012-13. The AO framed a best judgment assessment under section 144 because the assessee did not file satisfactory information. The AO's assessment included what certain income on best judgment basis. The CIT invoked revision under section 263, contending that assessment was prejudicial to the revenue. So issue was whether the CIT's revision under section 263 is permissible to substitute the AO's best judgment assessment under section 144. Very, very interesting. Let's see what tribunal observed and held. The tribunal noted that once an assessment is validly framed, Under section 144, which gives AOs wide powers, which gives AO to which gives wide powers to AO, mere dissatisfaction by CIT is not enough. The conditions for section 263 are stricter. There must be a failure of some condition of law or improper exercise or omission by AO. To invoke 263, what needs is a failure of some condition of law or improper exercise or omission by AO. The tribunal allowed the appeal in favor of the assessee, held that the CIT could not substitute his view for the AO's base judgment assessment in absence of specific infirmity. Base judgment assessment under section 144 cannot be replaced by revision under section 263 as if latter were an appeal. Next, Dadar Digamber Jain Mumukshu Mandal versus CIT ITA number 2446 Mumbai. Relevant assessment year is 2023-24. Date of order 15th July 2025. And relevant section is section 11 subsection 3. Let's understand facts and issue of the case. The assessee trust filed return for AY 23-24 claiming exemption under section 11. The return showed what accumulated funds under section 11 subsection 2 for financial year 16-17 amounting to approx 35 lakhs and financial year 17-18 approx rupees 40 lakhs. The AO processing under section 143 subsection 1 added back rupees 75 lakhs under section 11 subsection 3 on the basis that utilization window had expired as per amended law. So issue was whether the amendment by the Finance Act 2022, which removed the extra 1 year of accumulation beyond 5 years under section 11 subsection 3 clause C, applies to existing accumulations pre-amendment or only prospectively. Very much interested. Okay. Let's focus and let's see what tribunal observed and held. The tribunal observed that under the unamended section, that trust had 5 years plus 1 additional year, that is 6 years, to utilize the accumulated income. The amendment with effect from 1st April 2023 removed the extra 1 year. However, the tribunal held this change is what? Prospective and not retrospective. So for accumulation made in financial year 16-17 and financial year 17-18, the assessee's window of 6 years remains. The appeal was allowed. The additions under section 11 subsection 3 were deleted insofar as they related to accumulations before the amendment date. Amendment to section 11 subsection 3 clause C is a prospective one and doesn't curtail the utilization window for pre-amendment accumulations. Very straight. Next, the Foundation for IOT and IOEs versus CIT ITA number 2904 Mumbai. Relevant assessment year is 2025-26. Date of order is 10th July 2025 and relevant section is section 12AB. Let's understand facts and issue of the case. The assessee is a not-for-profit company under Section 8 of the Companies Act 2013, set up pursuant to a government ministry direction and hosted by IIT Bombay. It had existing registration under Section 12AB already for earlier years and applied for renewal of registration under Section 12AB for assessment years 2021-22 to assessment year 2025-26. The CIT exempt rejected renewal on the ground that the object of the assessee included what expenditure outside India, which according to CIT exemption might contravene section 11. So issue was whether mere presence of an object permitting future activity overseas or incurring expenditure outside India is sufficient ground to deny registration under section 12AB. Very interesting issue. Let's see what tribunal observed and held. The tribunal noted that denial of registration under section 12AB requires what? Concrete breach of conditions such as impermissible application of income and not speculative future possibility. Just see the contention of the tribunal. What tribunal noted that the denial of the registration under section 12AB requires what? concrete breach of conditions such as impermissible application of income, not a speculative future possibility. The assessee had not yet undertaken any such overseas application of income and had complied with conditions so far. The appeal was allowed in favor of the assessee. The tribunal directed CIT exemptions to grant registration under Section 12AB. Mere existence of objects permitting foreign expenditure means mere existence of objects, not application, only object. Permitting foreign expenditure doesn't per se invalidate the registration under Section 12AB. See how one interpret. Okay, interpretation of law is very, very important. Those who are dealing in litigation practice. Next, Kailash Chand versus ITO ITA number 565 Jaipur 2024. Relevant assessment year is 2012-13. Date of order 10th March 2025. And relevant sections are section 147. Read with section 144. Let's understand facts and issue of the case. The assessee who is in truck hiring business declared what gross receipts of 2.91 crore and nominal profit 0.37%. The AO issued notice under section 147, 148 citing bank deposits of 42.46 lakhs as escapement of income. Reassessment was framed and best judgment assessment under section 144 was made. Issue was whether AO in reassessment can make additions on grounds not covered in the reason recorded notice for reopening, that is a shift from bank deposit to other issues, and whether best judgment assessment under section 144 is valid in this context. Very interesting. Let's see what tribunal observed and held. The tribunal held that when the reason recorded under section 147 is challenged, AO cannot shift to entirely new issue not contemplating in notice. What tribunal held as when the reason recorded under section 147 is challenged, AO cannot shift to entirely new issue not contemplated in notice. The explanation 3 to section 147 restricts additions to the matter mentioned in the reason. The appeal was allowed in favor of the assessee. The tribunal held that AO's new or unrelated additions were invalid. Reassessment cannot be used to create fresh issues beyond the scope of notice. So AO's jurisdiction in reopening under section 147 and 148 is limited to what is stated in the reason recorded. Moving to unrelated matters invalidates the assessment even if section 144 is used. Next, Ravindra Madanlal Khandelwal versus Deputy Commissioner of Income Tax, ITA number 375, Nagpur, 2024. Relevant assessment year is 1819. Date of order 18th November 2024. And relevant sections are 68 and 36, subsection 1, clause 3. Let's understand facts and issue of the case. The assessee jeweler had taken unsecured loans from various lenders. The AO issued notice under section 133 subsection 6 to some lenders but didn't issue summons under section 131 and didn't examine all lenders or creditors for identity or creditworthiness. The AO made additions under section 68 unexplained cash credits and disallowed interest under section 36 subsection 1 clause 3 for some borrowings. So issue was whether additions under section 68 with related to unsecured loans and disallowance under section 36 subsection 1 clause 3 are sustainable where the AO's inquiry into lenders was incomplete, not all lenders questions, no section 131 summons, lack of adverse material. Let's see what tribunal observed and held. The tribunal observed that to make addition under section 68, AO must properly verify the identity, creditworthiness, and genuineness of lenders. In the present case, procedural lapses existed. Not all lenders queried. No summons under section 131. No adverse material to show lenders were non-genuine. So the appeal was priorly allowed. The portion of the loans that could be traced or verified was accepted. The balance was remanded to remanded back to AO for further inquiry. Procedural safeguard must be followed by AO before invoking Section 68 additions. Incomplete verification undermine the additions. So now we are moving to High Court. Okay, first, CIT versus Sanderson and Morgan's relevant assessment year 2007-8. Calcutta High Court, date of order 7th February 2024, and relevant section is section 4. Let's see what was the issue of the case. Whether amounts received by the solicitor from clients, amount received by the solicitor from clients for specific task which the solicitor held and spent on behalf of the client can be treated as his income under section 4 of the Act. Very important. So Calcutta High Court observed and held that the court observed that the excess receipts over declared income were explained by the assessee as a client advances and payments made on behalf of the clients, that is in a fiduciary capacity. Means whatever excess receipts over the declared income were completely and properly explained by the assessee as advances and payments made on behalf of client and is in a fiduciary capacity, and that no adverse inference under section 145 could validly be shown. The court held that the amounts held in fiduciary capacity and payments made as agent, purely agent, are not assessable as the assessee's income in case solicitor's income under section 4. So it is in favor of assessee. Next, Shravan Kumar Pathak versus State of MP. Relevant assessment year is 2022-23. Madhya Pradesh High Court, date of order 9th May 2024. Relevant sections are 132A of ITA Act and 397, 401, 457 of Criminal Code of Criminal Procedure. So let's see what was the issue. Whether proceedings under section 132A of the Income Tax Act, search and seizure, and ancillary powers under section 397, 401, and 457 of Code of Criminal Procedure, investigative and custody provisions were lawfully invoked in the given facts. Let's see what Madhya Pradesh High Court observed and held. The court noted procedural aspects regarding search and seizure records, rights of the petitioner under criminal procedure provisions, and the interplay between tax search laws and Code of Criminal Procedure powers. Detailed specific observations were not fully accessible. The petition to quash the proceedings was dealt with on the basis of the accessible summary. The High Court addressed the legality of invocation of these powers. Next, S.K. Jainal Abdin versus CIT. Relevant assessment year is 2006-7. Calcutta High Court, date of order 2nd April 2024. Relevant sections are 40 subsection section 40 clause A, subclause 3, Rule 6DD of ITR Rules 1962 and section 182 of Indian Contract Act 1872. Let's see what was the issue. Whether payments made by the assessee, non-resident or resident, to an agent or intermediary which lacked proper contract or documentation under section 182 of the Indian Contract Act and under Rule 6DD of ITR Rules 1962 are deductible or allowable expenditure under section 40A subsection 3 of the Income Tax Act. Let's see what Calcutta High Court observed and held. The court observed that contract law section 182, Rule 6DD compliance and arm's length or documentary support are relevant for deductions or payments under section 40A subsection 3. The absence of such support can render disallowance valid. So High Court held in favor of the revenue that the payments didn't satisfy necessary contract or documentation requirements, and hence deduction under section 40A subsection 3 could be denied. Next, RO Foundation versus CIT. Relevant assessment year is 17-18. Delhi High Court, date of order 5th February 2024. Relevant sections are section 2, subsection 15 proviso, section 11, 12, 13, subsection 8, section 194C, 194J, and 264. Let's see what was the issue. whether the entity, that is foundation, qualified as a charitable purpose under proviso to section 2 subsection 15, whether registration under section 1212A or 11 was valid, whether certain payments necessitated deduction under section 194C or J, and whether the power under section 264, that is revision, will be invoked. Number of issues involved. So let's see what Delhi High Court observed and held in that particular case. The court observed that the object and activities of the foundation in given case must align with charitable purpose. Registrations under section 11, 12, 13 require compliance. TDS obligations under section 194C or J must be fulfilled, and revision under section 264 must satisfy prescribed conditions. The High Court held that the foundation didn't qualify for exemption under the proviso to section 2 subsection 15 due to deviation from charitable purpose, and accordingly rejected registrations and held applicable TDS obligations and revisional power valid. So now we are moving to the conclusion part that can be drawn from today's learning. That is a one-liner conclusions from today's case laws. Let's see one by one. First, in cases of capital gains, taxpayers must accurately determine what nature of the asset and provide proof of its acquisition cost to claim appropriate exemptions or deductions. A valid based judgment assessment under section 144 cannot be reopened or substituted through revision under section 263 without specific error or prejudice established. Amendments restricting accumulation period under section 11 subsection 3 clause C operate prospectively and not retrospectively and cannot reduce time limits for earlier accumulations. Registration under section 12AB cannot be denied merely because the trust deed permits potential for an expenditure. Actual contravention must exist. Reassessment under section 147 must remain confined to the reasons recorded in our notice for reopening. Additions on unrelated issues are invalid. Additions under section 68 fail where the AO doesn't properly verify lender's identity, creditworthiness, and genuineness through due inquiry. That is a procedural lapses. Client monies held and spent in fiduciary capacity by solicitors are not taxable as their income under section 4. Search and seizure actions under section 132A must strictly comply with what statutory and procedural safeguards under both the Income Tax Act and the Criminal Procedure Code. Cash payment without valid contractual authority or documentation fail the test of Rule 6DD and are rightly disallowed under section 40A subsection 3. An institution engaged in commercial or non-charitable activities cannot claim exemption under section 11 as restricted by the proviso to section 2 subsection 15. So that's it for today. Thank you so much for patient hearing. Hope you are learning very valuable knowledge. You are getting valuable knowledge from this video series. Please note down my contact numbers and email IDs. And if you have any observations, suggestions, queries, do let me know. Okay. So stay tuned to the Tax Guru YouTube channel. If you are not yet subscribed, then do subscribe it. And if you like the video, please click on like and share in your network too. So happy learning. Bye bye. Take care. Hare Krishna.